If you're self-employed and you wrote off all of your income on your tax this year or last year, you might have just disqualified yourself from buying a house in Virginia. Yes, my friends, you heard me right. You did exactly what your CPA told you to do. I get it. You maximized your deductions, you claimed your home office, you wrote off the mileage on your car, and you saved thousands of dollars on your tax bill. But when you hand those tax returns over to a mortgage lender, they're not going to see a successful business owner. They see someone who makes zero money, and you make zero money on paper. And if you make zero money on paper, you cannot qualify for a traditional mortgage. And that's the exact trap that catches a lot of self-employed buyers off guard. You're making good money, your business is doing well, you have cash in the bank, but because of how the mortgage industry calculates self-employed income, you're suddenly being told that you cannot buy the house that you want, or worse, that you don't qualify for a mortgage at all. It is incredibly frustrating, and honestly, it feels completely unfair, but you're not out of options. Today, we're going to break down exactly how lenders look at your tax returns, why those write-offs are hurting your approval chances, and the specific alternative loan programs that can get you into a home without forcing you to pay the IRS more than you have to. We're also going to talk about your credit score, because when you're self-employed, if your score has taken a hit while you were building your business, I'm going to show you how to fix it fast so that you can get a mortgage approval. How does that sound? Hey friends, I'm Sonali Hudson. I'm a Christian realtor right here serving the greater Richmond and Henrico County area. If you are a self-employed buyer trying to coordinate buying and selling simultaneously without the stress, chaos, and the real fear of homelessness, you're in the right place. Every day, people just like you reach out to me about navigating the Virginia real estate market when their income does not look like a standard W-2. And I absolutely love helping everybody figure it all out, guys. We're not gonna rush, we're not gonna guess, and we're not gonna move in fear. We're gonna get your facts straight, and we're gonna make decisions with wisdom and peace. And that is the core of our homeownership God's Way blueprint. So guys, let us get straight to the biggest issue: how lenders calculate your income when you are a self-employed borrower. When a standard W-2 employee applies for a mortgage, the lender's gonna look at their gross income. That's the big number at the top of their pay stub before taxes are taken out. It's simple, it's straightforward, and it makes qualifying relatively easy. But when you're self-employed, lenders are not gonna look at your gross revenue. They're gonna look at your net revenue. That is the number left over after you've deducted all of your business expenses. And if you're smart, you've been deducting as many of those business expenses as you possibly could. So let us say your business brought in $150,000 last year. Guys, that's fantastic. But then you wrote off your equipment, your marketing, your travel, your home office, your cell phone bill. By the time your CPA or tax professional was done working their magic, your taxable income was down to, $40,000. You may have saved a fortune in taxes, which is great for your bank account today. But when the mortgage underwriter looks at your file, they're gonna divide that $40,000 by 12 months. They're gonna see an income of $3,335 a month. And with today's home prices and interest rates, an income of $3,300 a month is not going to get you approved for the house that you actually want to pay for, or that you actually deserve, because you've been working hard for it, my friends, right? So listen, this creates a massive conflict for business owners. Do you take the deductions and save on taxes, or do you skip the deductions, pay the IRS a massive $30,000, $40,000, $50,000 check, and show a higher income so you can buy a house? It feels like a no-win situation. And if you're trying to get a conventional loan or an FHA loan, it can really be unfortunate. Those traditional loan programs require 2 years of tax returns, and they're going to average your net income over those 2 years. So if you had a slower year 2 years ago and a great year last year, but you wrote everything off, your average is going to be painfully low. Ask me how I know, y'all. But here's the good news. You don't have to just use a traditional mortgage. The mortgage industry has finally caught up to the fact that the gig economy and self-employment are here to stay. And there are specific loan products designed exactly for these type of situations. Now, the most popular one, and the one that I'm a fan of, is called a bank statement loan. See, a bank statement loan completely bypasses your tax returns. The lender does not even ask to see them. Instead, they ask for 12 to 24 months of your business or personal bank statements. They look at the actual cash flowing into your accounts every single month. If you are depositing $10,000 a month from your business, they use a percentage of those deposits to calculate your qualifying income. They understand that you have expenses, so they're going to apply an expense factor, usually around 50%, but they're basing your approval on your real cash flow, not the artificially low number that's going to be on your tax return. Bank statement loans are a type of non-QM loan, which stands for non-qualified mortgage. They are an absolute lifesavers for people that are freelancers, contractors, and business owners. Now, there are a few things that you need to know about them. First, the interest rates are usually going to be slightly higher than a conventional loan. You're going to pay a small premium for the flexibility of not showing your tax returns. Second, they often require a larger down payment, sometimes just 10 to 20% compared to the 3.5% that you might put down when you have an FHA loan. So there's gonna be some give and take if you're thinking about using a bank statement loan, but it is an option. Now, this brings us to the most critical piece of the puzzle, your credit score. When you are applying for a bank statement loan or any other alternative financing, your credit score becomes incredibly important because the lender is taking on more perceived risk by not looking at your tax returns. They want to see that you have a strong history of paying your debts on time. If your credit score is struggling right now, I don't want you to panic. I don't want you to take this video as bad news. Building a business is hard. Trust me, I get it. And sometimes personal credit can take a hit when you're investing everything that you have into your own company. But if you want to buy a house in Virginia this year or in the future, we're going to need to get your score up, and we're going to need to do it strategically. So let's talk about what that actually looks like. The first thing that you need to do is look at your credit utilization ratio. This is the amount of credit that you are using compared to the amount of credit that you have available. It makes up 30% of your total credit score. If you have a credit card with a $10,000 limit and you have a $9,000 balance on it, that utilization is at 90%. That is going to drag your score down significantly. The golden rule is to keep your utilization under 30%. But if you want the absolute best possible scenario for a mortgage application, then you should aim to keep it under 10%. Let me say that again. Keep your credit utilization under 10% if you want to qualify for a mortgage and you have a non-traditional loan. Now, if you have cash available, paying down those credit card balances is going to be the fastest way to see a jump in your credit score. But what if you pay them down and then you need to apply for a mortgage next week? You don't have a 30 to 60 day window to wait for the credit card companies to report your new zero balance to the credit bureaus. This is where a strategy called a rapid rescore comes in. See, let's talk about what a rapid rescore is. A rapid rescore is a service that your mortgage lender can request on your behalf. You cannot do it yourself, okay? But once you pay down your debt, you're going to provide the proof of payment to your lender. They're going to submit it to the credit bureau with request for a rapid rescore. Instead of waiting a month or 2 months for your score to automatically update, the bureau is going to update your file in 3 to 5 business days. Now, I've seen buyers jump 40 or 50 points in a week just by paying down a credit card and doing a rapid rescore. It's an incredibly powerful tool if you're right on the borderline of qualifying for your mortgage. Now, what if your score is low because of errors on your credit report? You would be shocked at how common credit bureau errors are. Old accounts that you paid off years ago are still showing a balance. Late payments reported incorrectly. Even accounts that belong to someone else with a similar name could show up on your credit report. You're gonna have to pull your full credit report from all 3 credit bureaus, which are Equifax, Experian, and TransUnion, and you're gonna have to go through them line by line. Now, if you find an error, you're going to need to dispute it immediately. But here's the catch. Disputing an error takes time. The credit bureaus have 30 days to investigate your dispute. If you are planning to buy a house this summer, you need to be looking at your credit report right now. Don't wait until you find the perfect house in Glen Allen or Midlothian or Chesterfield to check your credit, because if there is a mistake on your credit, you're not going to have time to fix it before another buyer swoops in and takes that dream house away from you, okay? Now, I actually did a deep dive into the different neighborhoods in Henrico County recently, and if you're trying to decide where to focus your home search, you're going to want to watch that video. I break down all the property taxes, the schools, and the overall vibe of the area, and I'm going to link it right here for you to view. Make sure you check it out. I think it's actually going to help you. Friends, when you're self-employed, every single piece of your financial picture has to work together. Your income, your taxes, your credit, and your down payment. If you are feeling overwhelmed by this, I want you to just stop right now and take a deep breath. First of all, I got your back. You don't have to figure this out on your own. This is exactly why we created the Homeownership God's Way Blueprint. It's designed to take the chaos and the guesswork out of the buying and selling process. We're gonna sit down, we're gonna look at your specific situation, we're gonna connect you with lenders who actually understand self-employed buyers, and we're gonna build a clear step-by-step plan to get you into your own new home. Now, if you're worried about the down payment because you've tied up all of your cash in your business, there's also options for that too. Virginia Housing offers some incredible down payment assistance programs, including grants that you never have to pay back. Most of these programs require a minimum credit score of 620, which is very achievable if we put a solid credit repair strategy in place. Now, they do have income limits, so we have to look closely at how your tax write-offs impact your eligibility. Ironically, having a lower net income on your tax returns might actually help you qualify for down payment assistance, even if it makes qualifying for the mortgage itself a little trickier. It's all about finding the right balance and the right loan product for your unique situation. And of course, making sure that you connect with the right team and the right professionals who's going to walk you through it every step of the way. The biggest mistake I see self-employed buyers make is assuming that they cannot buy a home. So they don't even try. They just keep renting. They sign another lease, they keep throwing money on rent, and they wait for some magical day when their tax returns look perfect. Guys, don't do that. That's silly. I did it for years because I was too afraid. The rules are different for us as self-employed buyers, yes, but it doesn't mean it's impossible. It just means that we need a different strategy and a team that knows how to execute that strategy. I want to hear from you guys in the comments. Are you self-employed? What's been the biggest hurdle that you face when thinking about buying a house? Is it all the tax write-offs? Is it your credit score? Is it just the fear of the unknown or not knowing where to start? Let me know in the comments below because I read every single comment and your questions help me know exactly what to cover in my future videos. Friends, the bottom line is this. If you are ready to stop guessing and start planning, I have put together a comprehensive relocation guide that covers everything you need to know about moving to and living in the greater Richmond area. It is completely free and you can grab it right now using the link in the description. It is packed with the kind of local insight that you're not going to just be able to Google, and it's going to be the perfect first step on your journey to relocating to the Richmond market. And when you're ready to take the next step, I'd love to talk to you. We can schedule a consultation to go over your timeline, your goals, and how the Home Ownership God's Way Blueprint can work for you. And you can find all of my contact information in the description below. Guys, I hope this video was valuable to you. I promise you, I pour my heart and soul into these videos week after week. I want to make sure that I'm giving you real estate in a real way every single week. So thank you so much for watching. Your support absolutely means the world to me. And friends, listen, if you like this video, don't forget to like, comment, and subscribe. Don't forget to share this video with someone that you might think it can be a blessing to. And I'll see you in the next video, my friends. God bless you.